Hello, everyone, and hello to our audience. It's nice to have Fred Liu of Hayden Capital here today. Hi, Fred. How are you doing?
I'm doing well. Thanks, Stillman.
That's good.
Had a little bloop there, but quite all right.
Sorry for messing up the start, but before we start, we have to do some regulatory things, and I have to show you our disclaimer. Let's do that quickly. The key message is this is no investment advice. You have always to do your own research, and we are giving here opinions and qualified remarks, but it's no investment advice, and please do your own research. Fred, for the beginning, maybe let's start with a question that's from the non-investing space. In your last letter, you said that you're working on your cooking skills in quarantine. So what came out of this?
Yeah, so a couple things. I've never baked or made fresh pasta before, so that was my first achievement. I can say by the second time it came out pretty well. The next dish, made some stuffed cabbage, so ground beef, rice, tomatoes. That was a experience because usually I cook Asian cuisine, and so it was good to venture outside of that. And then the third thing is probably a Chinese dish from where my family is from, Xi'an. It's called mashizi. So basically little chunks of dough, carrots, potatoes, green beans, all in a stew, and very tasty. It was a dish that I had all the time growing up. So and it's hard to find in New York or in the US, and so you're kind of forced to make it yourself.
It sounds very tasty, and you should send me the receipt that I get some idea how to do it. But maybe should find a good Chinese restaurant to cook it for the first time. Let's switch to investing, and maybe let's start with the question how you're involved as an investor, and what were the best fails that contributed to your growth as an investor?
Yeah, so as I was saying earlier, it really starts at the beginning. I got my first shares of stock from my father when I was 11 years old. 15 shares of Walmart, right? And like I was saying, I distinctly remember bragging to my friends on the school bus about how I owned a chunk of Walmart. I think I've always loved that sense of ownership. Whenever we would walk into a Walmart, my father would say, like, hey, you own that door or that brick or that shelf. And I thought that was so cool. And then I took the wrong turn initially. By the time I could open a minor custodian account, when I believe I was 12 or 13 years old, I started day trading. I started listening to CNBC, watching Jim Cramer, trying to get the after-hours earnings pops. Needless to say, over the course of summer, I basically lost everything that I had. It was a couple $1,000 that I had saved up until then. Painful for 12, 13 years old. And I started going to penny stocks, really taught me around like level 2 quotes, bid ask spreads, all of that, right? So that was a good lesson. After that experience, I basically, I went to the library and basically said there must be a better way to pursue investing. And so the first book that kind of always stares at you is Warren Buffett, right? He's kind of the most famous investor. And so I picked up the book, The Warren Buffett Way. It was one of the first books. And then, I read a lot about value investing throughout that period, throughout middle school and high school. And by the time I got to high school, I knew I wanted to be an investor. Had done banking internships, had the classes at Columbia University by that point. And I really fell in love with kind of discipline. My dad wanted me to be an engineer. He sent me to like summer camp to try to like force me to be an engineer. I knew I didn't want to do it. He's a mechanical engineer himself.
What did you build at these summer camps?
Paper airplanes to see like who could fly it the furthest, like bridges to see, which ones can hold the most weight. Yeah. So yeah, that experience wasn't for me. So I decided to go to NYU, specifically because I didn't want that liberal arts background. I knew I was an investing nerd by then. I wanted to learn how to build models, run DCFs, what have you. And so, give me 1 second. Let me just close this.
Yeah.
Yeah. So after NYU, I went to JP Morgan Asset, and I worked on their small cap equity team at the moment. Uh, I had already developed a similar philosophy to how I think about investing today. When I first started off in college, definitely like everyone, I kind of gravitated towards the nets, the deep value type of names. Like I was saying, I think most investors that I know kind of start off in that space, either because it's simpler to understand. It's like a quantitative exercise rather than qualitative. And I think as an investor, you don't really appreciate the qualitative aspects of the business until you get more sophisticated as you progress in your career. My first stock was during that time was SL Green during the middle financial crisis. You could still find names like that. I was evaluating like what is the net asset value of all of the office space that they own within Manhattan, and trying to run calculations based on that and being able to buy it at like half their book, right, of what I calculated as their book. And then I eventually, like I said, made my way to JP Morgan. They had a much more quality kind of focus within small cap space, looking for names under $2 billion. We were 5 analysts, 1 PM. And so that really helped hone my philosophy a lot. The problem with working at kind of a larger asset management firm, a more institutional firm, is that there's a big push towards not only forced diversification, but also, for instance, we were closed at the time, but JP Morgan would like force us to open new products and whatnot. And I could just feel our time getting stretched. If we were evaluating a new name, I've talked to other friends at other firms. So it's not just firms like JP Morgan, but other firms as well. You only have so much time to go deep into each individual name. I felt like that wasn't the right way to pursue true investing. And so it was around that time that I started thinking about like, what does a great investment firm look like from a client standpoint? How do you structure the firm so that everything is aligned in the client's best interest? And then also how can, basically the frustration I also had and started realizing at that time, just talking to a lot of people in the industry, is I realized a lot of people sit behind their computer screens and think that they can have an edge on the market by doing that. They feel more comfortable because there's a lot more information on the internet nowadays. But I think the underappreciated part is really understanding the incremental unit economics behind some of these businesses. And you're never going to find that on the internet, right? By the time it's in a 10K or in a public filing, it's already relatively well known. So I think a lot of the edge in the market today is just doing your good old fashioned channel checks, talking to as many people as possible. So I wanted to eventually build a firm like that. After JP, I went to a firm called New Street, a boutique TMT research shop. They do really good work around the unit economic type analysis that I was talking about. And they also do really good work around building their networks and trying to get information from people that just through industry sources or through relationships that they already have. And so after New Street, I decided to launch Hayden. And we've kind of been pursuing that strategy ever since. It's definitely gotten honed over the last couple of years, but the basic core principles are the same.
So how many people do you meet a year if you do your research?
Sure, I think it's actually increased. I remember looking a couple months ago, and actually we did 300 plus meetings or calls last year. For me personally, I was looking at my calendar. It's about 5 meetings a week, so 1 a day. And then when I'm traveling, I generally try to pack about 3 to 4 meetings per day during my travels. And so that gets you into that 300-ish range.
With this quantity, how do you get the documentation on the quality of the meetings? Because it needs some time to work after them and prepare them as well. Or how is normal meeting looking like?
Yeah, I personally love meeting everyone. So whether it's company executives, former employees of a firm, whether it's like VC investors who may be investing in earlier stage companies, then we would look at to understand like what's going on in that segment of market and potential threats to the companies that we own, or it's just other investors as well, right? I think there's something to learn from everyone, and even if, let's say both of you have disagreeing views on a certain stock, there's always those are the best conversations, right? So I try to meet everyone that I can to get like a holistic view of a certain topic that I'm trying to have a better grasp upon. And so meetings, the meetings take a little bit of prep time, maybe like 30 minutes, 45 minutes beforehand, just writing down a couple questions. But, other than that, the conversations flow pretty naturally.
Interesting. I already see that there are some questions coming in, so I will walk you to these questions, but maybe let's go to the next question. How would you describe your edge as an investor?
Like I said, I think a lot of people sit behind their computer screens these days, and they feel comfortable with that. I think as an investor, your best edge is, let's say you have a deep understanding of a certain industry. Maybe you work in that industry, talking to all of your colleagues, all of your clients. I think that's the best edge, because a lot of people on Wall Street are sitting in New York and they may not use these products or have ever seen anyone use these products. And if you're sitting, I don't know, in an emerging market and actually have firsthand experience with it, I think that's a real edge against a lot of the investors, the more professional investors. And so I try to do the same thing, even though, for instance, we have some investments in Southeast Asia, I can't really use the product, but talking to as many customers as possible, I think helps me get closer to that firsthand experience.
Interesting. You have a certain focus on Asian companies. Can you maybe help me and other viewers with things that desk-based investors and other investors usually get wrong about Asia? And what are interesting opportunities in this space?
I think number one, I think people still have a strong, at least in the West, people still have a strong bias against Asian companies, Asian management teams, whatnot. I think what needs to be said, and I think what people need to understand, is that, call it 20 years ago, the people who got rich in China, especially, call it 20 years ago, they were the ones who basically grew the quickest. They weren't the ones who were necessarily the smartest, the best at allocating capital. They just basically threw money into as many products as possible. And because the company was growing so rapidly, or the country was growing so rapidly, they kind of got carried away with that tailwind, right? And they benefited from it. If you look at, for instance, average incomes in China in the early 2000s up to until 2010, 2012, it was growing at a high teens CAGR. Imagine your personal salary growing 20% every year, right? That instills a different type of mindset, like a can't lose type of mindset. But as China has slowed, I think, and just anecdotally, I've noticed this as well, a lot of management teams are becoming more rational. A lot of management teams have experience with Western companies or have worked inside of Western companies. They have a much better sophistication around capital allocation, return on invested capital, what have you. And so these companies are changing. It's just a natural dynamic that you see when a country starts maturing and the pie doesn't grow so rapidly that you can just toss money against the wall and it's going to bring you back $100 for each dollar that you throw. And so you're starting to see that in China today. And I think Asia changes so rapidly that if you have a bias from even 5 years ago, 10 years ago, that bias is probably outdated. So I think that's probably something that not a lot of people quite appreciate just yet. I would just suggest anyone just go visit Asia if you haven't already, and then start talking to people. I think you'll be pretty impressed with the business environment there.
What are your recent takeaways from your trips to Asia?
I know we've talked about this before. One of our largest positions is Sea, right? The biggest takeaway in Southeast Asia is that it's starting to hit, what's widely called as like the golden zone, right? That $2,000 to $4,000 USD GDP per capita. You've basically reached a level where families can kind of feed themselves. They can take care of basic necessities. And so the play is really as each family gets an incremental dollar of discretionary income, your discretionary spending literally gets multiplied by 3 or 4x as compared to before. I think that's the biggest opportunity here. You're starting to see a lot more startups come up as well. There aren't quite that many listed companies. Sea is a great example, but they're listed in New York. In terms of local companies, the quality isn't quite there yet. But if you look at the earlier stages, the Series A, B, C, there's quite a few called like mature tech firms in the region. And I think over the next 5 years, you're going to see these firms succeed, and they're going to start being listed. And I think part of the opportunity is just understanding that market, getting ahead of it, so that in 5 years, when these companies start being listed, you have an advantage there.
Interesting. We already have some questions. I think the questions on Carvana I will put to the later part of the interview. But we have a question here from Frank. How do you think Shopee is competing with Lazada today? Where are they each in terms of positioning today?
Yeah, so I think Lazada has recognized the error of its ways, so to speak. Basically, they started off as a predominantly 1P retailer focused on high value categories like electronics. And the problem with these types of categories is that it's a low frequency purchase, right? You don't really buy a new computer every month. You don't buy a new cell phone every month. And logistics is very expensive. Versus where Shopee started out is that it was predominantly fashion and beauty focused. If you think about like a dress, it's very easy to ship. If you look at surveys in the region, a lot of people are willing to wait in terms of delivery time for a piece of apparel versus maybe a brand new cell phone, right? A cell phone you may want tomorrow because you have some urgent need for it. And so that's where they started off. And they started off in the C2C marketplace, focusing on kind of long tail inventory. Lazada has basically started moving in the direction of Shopee as well. And Shopee likewise has started, selling electronics, home goods, normal household appliances and whatnot. So I think you're starting to see them converge a bit. But the difference is really in the culture of Shopee. They're really good, fast followers. If they see a new innovation or product feature from Lazada, they're very quick to basically implement the same thing, and do it about 3 times better, basically. So I think at this point in time, because the market has matured somewhat, that people have formed their own habits, their own shopping habits. For Shopee, your average number of orders per month is somewhere like 4 or 5 times a month, right? If you're ordering that frequently, that brand stays in your head. So next time you do want to order something, your first go-to is Shopee, and you probably already have the app downloaded on your phone. And your phone is probably a low spec phone, doesn't have that much space, so you don't want to download too many apps. So these apps become almost like real estate on your mobile phone. And if the average number of times a person visits these stores is multiple times a day, right? And so it's similar to going inside of a mall, call it 5 times a day. You may not buy something the first 4 times, but the 5th time you walk past something and it seems attractive, so you make that purchase. It's the same thing that Shopee is trying to invoke right now. Get people using the app, get people spending as much time as possible on the app, and eventually they're going to find something that they like. So, they just do a much better job of that than Lazada. And they, in Indonesia, they're, basically a #1 player. Lazada, I believe, is like #4, last I saw. In other countries, they're a little bit more neck to neck, but Shopee seems to be growing quicker. So I think by this point, 2 years ago, the market controversy was how is Shopee going to be able to compete against the capital cannon of Alibaba and SoftBank? I think that question's been kind of proven out. already, which is why you see where shares are today. But I think it's only just the beginning. Shopee is just starting to prove that they are the winner in the market. And typically you see e-commerce as a winner take most type of market. And where you see the profitability come through is when the marketplace is 2 or 3 times larger than the next largest marketplace. So you can look at Shopee in Taiwan, for instance, right? They have the dominant portion of market share, called like 70-80%, right? And that's where they're most profitable. So if you watch how market share trends versus relative to other players, that's a good proxy for their eventual profitability as well.
Maybe let's go a level higher or
Sure.
more to the basics for our German viewers, because I have to admit that I'm not the best expert in the Southeast Asian shopping market. Can you maybe describe some of the basics of the name you just mentioned? And also the background of Alibaba. There was also one question coming up.
Yeah, so I mean, Sea really operates 2 core main businesses. They have the third emerging business. One of them is gaming. The gaming started off as a republisher of a lot of Tencent games. And so that's a beautiful business. It requires very little capital. If they already know what games are successful in China, they have the right of first refusal to basically cherry pick the best games, localize it, change the language, integrate it with the local payment methods, what have you. So that's a beautiful business. And then they have basically taken the cash flow from there. They're going to generate about, call it 1.2 to 1.4 billion in USD EBITDA this year. And they've taken all of that cash flow to reinvest into Shopee, in addition to some debt as well. And Shopee is an e-commerce marketplace. And how it differs from something like Amazon or, like I was saying, Lazada, is that they started more on the on the social networks. A lot of sellers at the time were selling on platforms like Facebook, Instagram, what have you. And so they created a system that was very easy to take these seller shops off of Instagram and import it onto the Shopee platform. On Instagram, basically, people would load these posts, right, of items that they have, and then you would DM them and negotiate, the pricing, payment, where to send the payment, where to send the item. And it was a very clunky experience. And they noticed that a lot of people were doing that through their Talk app. And so they launched Shopee, which is a more formalized, the lower friction type of marketplace, predominantly C2C, so consumer to consumer is where they started off. And so that business has grown, from 2015 to today. We think they're going to do about over 30 billion in GMV. On a overall level, they're still not profitable, but you have to look at it on a country basis. Like I said, Taiwan's already profitable, Indonesia's probably break even, and then the other countries, we're sure that they're going to break even within the next 2 years or so. So that's their second business, and that's kind of what's driven the stock over the last year or so. And then their third business is called Sea Money. It's basically their e-wallet platform. In addition to, they offer seller loans. And so this really is synergistic with the Shopee business, because a big issue in the region is kind of these sellers are like mom and pops. And so they may store their extra inventory in their called second bedroom. And so they have a bunch of these holiday sales. You have like 10-10, 11-11, 9-9, 12-12. And you get these huge spikes in these holiday sales. And so as a seller, the biggest problem is that you often run out of inventory during these sales. And so these sellers need working capital in order to kind of meet those spikes in demand. And so that will help. It will help with retention. And then also, as a e-wallet platform, they're starting to go offline as well. And so we can see kind of, what Alipay has done in China to get a good idea of what the roadmap looks like for Shopee Pay. So yeah, those are the 3 core businesses of Sea at the moment.
Do you have any idea where you see this company in 5 or 10 years?
I know Forrest thinks that this is going to be $100 billion business. It's in I think it hit 40 billion today. It still has a ways to go. The thing with these types of companies, we invest in relatively earlier stage companies. When you have market penetration of, a couple percent, it's really hard to gauge where the market is going to mature in 10 years and 20 years, right?
How much is the internet penetration or in these countries?
So e-commerce penetration, I mean, is like 3%, right?
There's some way to go.
Right. You still have a long ways to go. You see China is probably the most penetrated in the high teens, close to 20%. But they're still growing very quickly. You have Amazon in the US still putting up 20% CAGRs, despite being e-com penetration 4 to 5 times higher than the region. And the thing is that generally e-commerce penetration tends to follow like density in a city or density in a geography. If you're in the US, like right now, I'm currently in Cincinnati in the suburbs, you can drive to a Walmart or the mall or whatever pretty easily, right? But if you're in a city of 20 million people in China, going to the store is a really big pain. And so you tend to use these e-commerce services a little bit more. It's why you see like food delivery taking off in China as well. So I would think that Southeast Asia, because it is more dense than places like the US, will be able to exceed where the US kind of peters out in terms of mature penetration in the market. But it's too early to tell. These businesses change over time. Consumer habits change over time. There may be, I don't know, instant teleportation of goods that you order, and maybe someone will come out with that in 20 years or something. So it's really hard to gauge where the top of that S curve is. So I would just say, look maybe 3 to 5 years ahead. You can probably get more confidence there. But as to where these firms hit that top of the S curve, you should keep a close eye on it. But it's anyone's guess.
Yeah, it's about the future, and the future is uncertain. But you can make some predictions based on the patterns you've observed somewhere else and the chances you have and the user patterns. But maybe let's go back to the nearer past, the year 2020. What a year till now. How have you found value in this crisis, and how have you positioned yourself from the beginning of the year on? You had some Asian insider information, as I read in your letter.
I don't know if it's inside info. I mean, if you were paying attention to the news and reading Asian news, you could kind of tell what was happening with coronavirus and the impact that it was having on businesses. Yeah.
And how did your year evolve during the last months, and where have you found value in this last month?
Yeah, so our portfolio was relatively insulated. We had some hedges on, and they added a couple percent to our portfolio, but it wasn't significant. Our portfolio was relatively protected because we do operate we're invested in a lot of these internet retailers, right? And so when all of your brick and mortar shops are closed, especially in emerging markets, customers that may not have used a service like that before, they have no other choice but to use, say, e-commerce for their daily needs. And so it actually attracted a lot of customers to these platforms, and it was effectively free customer acquisition, right? And so a lot of these companies benefited from this. Shopee reported, I believe, 140% year-over-year GMV growth back in April. I think the opportunity was that when coronavirus was really starting to hit the West, a lot of people thought that people would just cut back on spending in general. So you saw some of these names take a hit in the early part of March, later part of March. And then people quickly realized that these are actually beneficiaries of this trend, and that a lot of these customers who may not have used these platforms before, if you have a great mousetrap, they're going to stick inside of that mousetrap, and they're going to refer more of their friends, right? Even after coronavirus ends. And so I think that's why you've seen such a rapid rebound in this space. I think that one thing that's interesting is that a lot of people, and I talked about this in my last letter as well, that a lot of people are trying to look at the traditional brick and mortar space and gauge when is the US going to open up When are certain countries going to open back up? When is traffic going to normalize, right? And I think that's a really hard game to play, at least from my standpoint. I think a lot of people won't make a lot of money doing that. But in my view, I think I just don't have an edge there. And so I think the best opportunity is actually think about who is a beneficiary during periods like this. If you think about a lot of these tech companies, these internet companies, you've seen the news about like work from home and whatnot. These are very resilient type of businesses, right? If you can have your entire workforce basically working from home and not be in a physical office, not have to have a physical presence, that's a really resilient type of business, right? So I think the opportunity is really even in the emerging space where things like Shopee have 3% market share. There's other companies out there we were looking at, like buy now, pay later type of companies. These are a small portion of the market. Businesses that have a superior mousetrap, that you know that once people learn about this business model, that they will use it, that they think it's a superior way to buy something. And so these types of businesses, because they're so nascent and the biggest friction point is educating consumers, they benefit the most during something like this, where consumers are naturally looking for a way to buy things online. So I think a lot of investors should kind of focus their time there, in my opinion.
And there was also one question on how you remain patient in this rally we are currently in. It's I think for myself, it's a paradox market, but
Sure.
how do you remain disciplined in this surprising rally?
Well, I personally still think our names are cheap, and so that so I think that helps with the patience, right? Things like Sea, one of our largest position, even at $40 billion, I still think it's probably one of the easiest buys in my portfolio today. Just given the level of risk that they've proven their dominance in the market, and kind of the massive macro tailwind behind them, whether it's an industry tailwind or a even GDP type of tailwind in these countries. So yeah, even though names like that have been very successful for us this year, I would recommend to new clients, to continue buying them as well.
And maybe adding onto this observation, where do you see parts of the markets that are overvalued for your guess?
Yeah, I focus on my core competency is in a very small sliver of the market, right? As you can probably tell. Mm-hmm. And so in my space, I think the place to look for shorts is probably, a lot of these names have basically been driven by this whole trend towards work from home. People are talking about you should buy all of these tech stocks, these internet stocks, what have you. The question is that if you don't have a great mousetrap, but people are forced to enter that mousetrap because they have no other options, they're going to leave as soon as the country opens up and people are allowed to, go into stores again. And so the question is, which companies actually do have a superior mousetrap as a business model, as a product, serve their customers the best, as opposed to their customers just being forced to use the product during this period of time, and they're going to leave as soon as they have a chance. Those are probably the most overvalued segments of the market right now, because I think we're in a period, at least within the last, call it, month or two, everything is just kind of trading together, and everyone thinks that these internet companies will all benefit, and that's not true. Some of these will go back to kind of the levels that they were at in terms of consumer demand and whatnot.
How do you get confidence about the chance that people will leave the mousetrap soon?
That's qualitative, right? So it's either you can talk to as many consumers as possible, you can do surveys, you can use, for instance, case studies, you can use alt data to kind of track it on a weekly basis. It really depends on the individual name. But I think you need to make a judgment, right? Do you think that this company's value proposition to its customers is superior to the brick and mortar alternatives? Yeah, it's going to depend.
You just said, I hope I get it right, that Sea is still cheap in your eyes.
Yes.
What must or what could happen that it might be revaluated and getting some valuation or valuation that makes it not that cheap anymore?
I think
what are driving forces of, or let's put it as a question in general, when is it especially interesting to invest in such online retailers and when you can profit from the revaluation? We already talked about this
right.
topic a bit.
Right. So I think there's this idea of you have to think about how quickly the intrinsic value of a company is growing, which you can use as a proxy, call it like their current earnings power, right? If earnings are CAGRing at, say, a 50% annual basis, right? That's pretty impressive. If you're able to buy a company like that at a multiple or valuation that doesn't imply any future growth, that's basically the type of situations that we look at. You know, when we bought Sea, it was about a $4.5 billion company. We thought the gaming business alone would make up the significant majority of that. Plus, they had a good chunk of cash on their balance sheet, and so the market wasn't valuing the Shopee business at all. And so those are the situations where you have Shopee that grew, you know, over 100% for a couple of years, and their earnings power kind of grew in line with that. And on top of that, as they kind of prove to the market that this business is stable, this business is capable of generating cash flow, and that they will be the winner in the market, you get a valuation re-rating, right? You literally started at basically a multiple of 0. And now I'm sure the market is valuing at, you know, close to 10x or what have you. And so I think with these earlier stage companies where it's a new business model, maybe it only started existing a couple of years ago, you need to have confidence that even if they aren't profitable yet, that they do have a pathway to profitability, and that it all derives from what is their relative market share versus competitors, and what is the customer value proposition, right? The problem is that a lot of public investors aren't comfortable making those type of judgment calls. A lot of public investors may not do the necessary channel checks to actually understand what's going on behind the scenes, what makes one marketplace sticky versus another, what makes, say, you know, the average customer of one marketplace use the product for an hour a day and the other one maybe 5 minutes a day, right? And they may be valued similarly. So I think for these companies, you need to be able to have those kind of data points to understand what are the early signs of a marketplace that's going to grow quicker than its competitors, and then be willing to take that bet. I think that, you know, for certain names, they do get overvalued. So you want to think like, if your earnings are catering at a 50%, but it's pricing in, say, the next 4 years of growth already. And so actually, let me see if I can draw something for you real quick.
It would be good. Then I take the chance for in the short break to ask for more questions. So I'm happy to receive more questions from the audience. We still have around 25 minutes to go, and we will also do something on Carvana, but let's continue with your drawing. I'm happy to see it.
Sure. So it's done. So basically, if you think about an S curve, right? This is the S curve, this break even. If you're operating in this area, right?
Yeah.
Your intrinsic value, maybe call it CAGRing at 60%, but let's say the price is here, right? So as an investor, the return that you're going to realize may be like a 20%. It's the slope of this curve. Say this is 5 years out or 3 years out or what have you. If you're able to buy it at valuation of here, you're going to realize the same CAGR as that earnings power, right? But if it is a higher than, you know, multiple that's justified with where the business is today, you're probably paying a higher price. And so you need to evaluate what is the slope of this curve. If this slope falls below, you know, we use a rough estimate of call it like 10% over the next 3 years, even though it might be a great company. I think it would be in times like that where you should consider starting to trim the position. But, you know, everything that we hold today, I think we'll be able to meet bar pretty easily.
The first stock I came into touch with you was JD, because we had a very lively discussion in Germany about JD as an investment.
Sure.
2 years ago or something like that. And is JD an example for this kind of revaluation, and you sold it to that reason, or did you sell it because there was other reason to sell?
Yeah, so I think in the case of JD, anyone who's interested can read our letter during that period. I talked about it last year.
I will link them below so you can find the letters of.
Sure. But yeah, I think by the time we bought it, JD was pretty well known in the market anyways. It wasn't a case of, Shopee. JD was started, I mean, at the time it was even started 15 years before we bought it, right? And so in that case, the issue with the name was that the product itself had a similar issue to what Lazada has today. It's very electronics focused, very male focused, and honestly, male consumers don't leave very detailed reviews. They don't refer products to their friends. They don't refer companies to their friends. So that segment of the market is an issue as well. And the real problem is just the low order frequency of that platform. And so we found better opportunities in cases like Shopee, where, like I said, customers order multiple times a month. The basket sizes are very sticky. It's a fun product to use. JD is more of like an Amazon type model where it's about efficiency, right? You saw them benefit during this coronavirus period because they have their own internal logistics system. They're able to get your items to you basically on the same day. The problem is that your average customer may only use the platform 2 or 3 times a year. And so you constantly have to reacquire that customer as well. And so I think that just added a lot of friction. I'm sure JD will continue to do just fine. We just saw better opportunities.
Interesting. Was there also a reason to also get one question from the chat with the internet space in China, and how do you see the movement there?
I would say China is getting very competitive. And so I don't think you're going to see the same opportunities in China as, obviously 10 years ago, 15 years ago, when a lot of these behemoth companies were founded. You do have new companies such as ByteDance that do have a much more international approach from the get-go. So that keeps it interesting. But, the cost to acquire customers everywhere is going up. And so that's why you see a big pivot in China. In my opinion, I talked about this in a prior letter as well, the whole trend of super apps, right? Being able to offer multiple services, multiple products on the same app, because once you acquire a customer once, you can then kind of diversify that cost across all these different product lines. And some products may be run at cost in order to just retain the customer. And then other products may be low frequency, but high margin type of lines, such as, hotel bookings or whatnot. And that's what really kind of provides profitability to the business. But in general, I'll say that, China is just becoming much more competitive nowadays. I think a lot of Chinese companies are actually out executing the Western internet companies. You're seeing a lot of, one of our themes is the cross-pollination of these business models, right? Because you have a lot of Silicon Valley type of companies that are keeping a close eye on what the Chinese companies are doing. Like if you launch a new feature, like let's say live streaming, right? And it increases the average retention of your users. As Amazon, I'm definitely going to take a close look at that and see if it's applicable to the US consumer as well. Because you kind of have a roadmap already, right? That's already been trialed in China. And you may have slight differences on the margins, but consumers are generally the same globally. So yeah, I think that a lot of these companies are becoming more mature, more sophisticated, and it's becoming a little bit tougher to find good values there.
Interesting to hear that. I will now go to the questions on Carvana, and we'll start with the first from William. His questions is about what you think about Carvana's partner inventory program from a unit economics perspective compared to the normal retail sales.
Yeah, I think it's a little too early to know for sure. I mean, they've never talked about it publicly. They just started trialing the program. I think it's really too early to know for sure what the unit economics are going to look like. But if you think about the benefits of the program, right? You think about the benefits that Carvana provides. It's really around, your Honda Accord that Carvana offers isn't going to be that much different than Carmax's Honda Accord or your local brick and mortar dealers, right? The benefit that they provide is the convenience, the trusted brand, the logistics network, the reconditioning centers. And so they're basically following the Amazon playbook, right? Prove to the market, educate the market. And then once the market is basically primed with your own product, then start opening it up to third-party partners, and then charge them for the most valuable parts of your business, which is, basically shipping the car or the book or the product to the end customer, and then leveraging your brand. They've spent a ton of money on marketing. They have great brand awareness in the market. Imagine you're a local brick and mortar player. There's no chance that you can have that same level of brand awareness even within your local market. So you can kind of charge for that. And then eventually, most likely, they're going to move into kind of like a sponsored placement type of model, perhaps. But I think as in terms of specific numbers, I think it's too early to really know for sure.
To learn more about Carvana, I will also link the interview I had with Cliff Sossan, who has heavily invested in Carvana, up here. So you can have a look at this also. There's another question on Carvana. You said in your letter, like the question says, that you said in your investor letter that Carvana is a bet in the management team, the ability to execute a business. What's your current thought on management?
I think they've done everything right. Like I said, I wasn't expecting them to kind of launch a marketplace model this quickly or to even trial it. And the fact that they're doing it, I think, is something. So when you're evaluating management, right, I always wanted to think that as an investor, you should put yourself in the shoes of management and say, what if I were running this business, what would the roadmap for it look like, right? And I think marketplace, if I were running it, marketplace and the whole Amazon fulfilled by Amazon playbook is something that I would definitely try. And you can tell management is thinking in a similar way, right? So that I think gives credit towards the quality of Ernie and the entire team at Carvana. So yeah, my opinions haven't changed at all. And you see during periods like, the last couple months, they raised money, even though they honestly didn't really need the money. They're using it to get more aggressive during this period, to take share at a above trend level than they were going to do before. And so I think when your competitors are hurting, and you aren't as much, that's when you should be getting aggressive. And they have access to capital that your local brick and mortar guy isn't going to have. And so why not use that to your advantage? So I still think highly of them.
Is there also some reflection in numbers of the way they are getting more aggressive?
I think they'll probably release some details, but a lot of it is going to be around building out their inventory, call it like their marketing channels, building out their vending machines, reconditioning centers, whatnot. I mean, like I said, I'm sitting here in the suburbs of Cincinnati at the moment, and 15 minutes away, Carvana just announced that they're going to build a 40,000 square foot reconditioning center, hiring 400 or 500 people. They just announced that. Which I don't even know if they've announced it, but it's in the local news. So you can see them doing things like that. Yeah.
There's one question from Frank. Couldn't Carmax go straight to customers? I believe they're doing that already.
Yeah, they are. I think what's interesting is that with these industries, these nascent kind of business models of selling used cars online, when you're at, this entire industry is, 1-2% penetration of the market, depending on how you want to cut it. At that level, the biggest friction point is around consumer education, right? CarMax absolutely can do this. I don't think that it's going to be a winner take all type of market. But when you're at 1 to 2% penetration, the biggest problem is just getting people to know, like, hey, you can buy car online sight unseen, and yes, you can trust it. And the more players that you see kind of piggybacking on each other's marketing spend, the more beneficial it is for everyone. And especially in a case like a used car, right? You're going to spend at least 10 hours evaluating what model you want, what dealer you want to buy it from. And during those 10 hours, if you came because of a CarMax commercial, you're probably going to make your way towards Carvana because you're obviously going to price shop, right? And then if Carvana offers a better experience, if they offer a cheaper price, you'll probably use them, even though it was CarMax that paid for that marketing. You see this across other industries as well. For instance, Shopee Pay, right? Or Sea Money in the case of Sea, they let competitors basically burn billions of dollars on this e-wallet initiative in Indonesia to basically educate the market. And then nowadays, as of a couple months ago, they start getting aggressive because the market is now educated. And so they can come in with the biggest use case, which is e-commerce, and automatically, they reported 40% of their orders in Indonesia were through their own e-wallet this past quarter. I think when the total industry market share as a percent of the addressable market is at single low digits, you don't really need to worry about competition as much. You just need to focus on executing yourself. It's when you start getting to that high single digit, call 9-10% penetration, that's when you start butting heads against your competitors. And that's when the pie stops growing as rapidly, right? Because now you need to basically take a piece from someone else in order to continue growing. That's when you start seeing the problems around competition. But at a very, very early stage, I think actually the more marketing dollars that go into it, the more it benefits everyone.
Maybe we could go back to your drawing and where do you see Carvana on the S-curve currently?
Well, they haven't broken even just yet, so they're probably below this line, like right there.
And where do you see it in 5 or 10 years? Better 10 years to take the long-term view.
Sure. 10 years, again, we don't know where it's going to be. We have to, part of our process is reevaluating these businesses every 2 years, every 3 years, what have you. So I don't know where it's going to be. That's too far to call. We have to reevaluate as we go. But, within a couple of years, I think they're going to break even. I think in our model, we have them doing like 15 billion in sales within, call about 4 years or so. And at those types of levels, at a normalized margin, they're going to be doing like $1 billion plus. So the question is, where do you think that a business like that should be valued?
I don't know at the moment because I'm not a specialist.
Sure.
How flexible are you in your thesis if you say you're evaluating your thesis every 2 years?
I think you have to constantly reevaluate. I mean, I also talked about this in a letter about in a concentrated portfolio like this, and especially investing in companies that are a bit earlier on the S-curve, it almost follows that Pareto principle, that 80-20 rule. And it's almost similar to like a venture fund, right? There's going to be a handful of winners that really drive the majority of your returns. And so you have to be cognizant that a lot of your names may break even, they may not work out, and your thesis is probably going to be wrong a lot of the time. So to answer your question, you have to be very flexible because that's just part of this model, this strategy.
So how much time does it take for you to change your thesis and also to admit that you're wrong?
Probably longer than it should take. But generally, it depends how wrong I am, like the degree to which I'm wrong, right? If it's a fixable problem or not. And then, in certain cases, I may, if I think that management has a plan to kind of fix that problem, I may give them some time to see if they're able to. But I think it depends on a case-by-case basis.
I like those questions where I ask you, where will be something in 5 or 10 years? And Dennis, Hi, Dennis. Nice to have you here as well. Ask a question, where do you see Hayden Capital in 5 or 10 years?
I would hope that we are still in business, number one. I'm very confident
Would
of
be
that.
good. I think there's certain chance for that.
Number two, I want, I think our core process is there. I think that, like everything that we do, we have the tools in place. As we grow larger, I hope to basically add depth to that process. So in terms of whether adding more analysts, I always talk about like thinking about analysts like hunters. That's who I'm looking for. I'm looking for autonomous idea generators rather than, I can build a model myself. That's no problem. So I hope to be able to add to that. I hope to be able to add people perhaps on the data side in order to kind of prove out these features, these theses quantitatively. But other than that, I think Hayden will always be concentrated. I think we will always be investing in these types of companies. Hopefully my circle of competence will have expanded by that point to encompass adjacent industries as well. But at its core, I don't think Hayden will change that much. You'll still recognize the firm strategy and what we're doing.
Do you already look for applications?
Sorry?
Do you already look for applications for Hayden?
For the right people, I'll definitely keep them in mind.
Okay, they can contact you on Twitter. I hope your messages are open, otherwise you have to open them after this interview. We are coming to the end of our interview, and for the end, I want to give you the room if you want to add something we haven't discussed or shed light on an aspect you want to go deeper into. So the floor is yours.
Yeah, I think the biggest takeaway for me, and again, it goes back to what I was saying at the beginning of the interview. I think investors are too welded to their desks nowadays. They rely on secondhand research too much. I think we need to go back to where the industry was maybe 50, 60 years ago. Actually picking up the phone and talking to people, actually grabbing coffee and going to meet people. One of my former bosses used to say, there's someone in this world who has the information that you want, and it's your job as an analyst to go find that person. And I think that's something that I've definitely taken to heart. And I think a lot of investors will benefit from that because there's so much information that's just in people's heads, and you're not going to be able to get that unless you build a relationship with them and meet them face to face. So that's my last piece of advice there.
And for me, it's also the message to add. You need also social distance as well in these times. The virus isn't over, and I hope we don't have a second wave. Then
sure, wear a mask. Yeah.
Yeah, mask outside or yeah. But social distancing and mask are important. So thank you very much for the interview, and thank you very much also for our audience that you asked us good questions and helped me asking Fred good questions. Thank you very much for joining us, and subscribe. That would be great that I get more subscribers and the channel gets bigger and more people see the content. Thank you very much.
Thank you. Thanks, Selma.